Okay, we're into that time when we bring you year-end scorecards, and I'm just looking at the TSX Energy Index, which of course includes uranium players. CES Energy Solutions, the top gaining stock in that index this year, and it looks like it's number 2 for the entire TSX index, composite index in 2024, behind Celestica. Our guest is bullish on the stock, says despite the outperformance, it still offers a reasonable cash flow yield. Let's bring in Michael Barth, equity research analyst at Raymond James. Great to see you, Michael. Thanks very much for coming on.
Thanks for having me back.
Can you remind me, is this company, they sell specialized chemicals and fluids, I think, that are hard for oil and gas companies to get elsewhere?
Yeah, there's 2 components to this business. There's drilling fluids, which is a mission critical component when you're drilling and completing a well. And then there's production chemicals. So it's a small share of wallet, and again, a mission critical additive used when you're producing hydrocarbons of any kind.
That's interesting, small share of wallet. So it's not a big cost component. So I guess you're less averse, as a customer, you're less resistant to price increases.
I think that's a good characterization. It's still a competitive space, but there's less focus there than there would be on an active rig.
Right. Now, you say that right now it's trading at a cash flow yield for next year of around 11%, which is not bad for a stock that's almost trebled this year.
Yeah, sustaining free cash flow yield of barely into the double digits, but double digits nonetheless, I think is attractive considering there's still some great macro or secular tailwinds behind this business. The balance sheet hasn't been this good in 10 or 15 years, and their incremental returns are fantastic. So they can grow this business, max out their buyback program, and pay the dividend. So we still think there's good value in the stock today, despite, like your earlier points, pretty incredible run year to date.
What are the tailwinds for CES right now?
So the industry pie continues to grow. And so just generally, as production of hydrocarbons increases across North America, you see demand for production chemicals go up. But the other secular theme is that drilling and completion intensity and complexity continues to increase, which means you need more additives to bring those hydrocarbons out of the ground. So the industry pie is growing, and year in, year out, they continue to take market share. So they're taking a larger piece of that growing pie every year, and we think that continues. And then on the back of this growing top line, we've also seen margin expansion as the product mix shifts to more profitable products and services. And so everything is working in their favor at the moment.
If U.S. oil and gas production, domestic production increases under the Republican administration that'll be taking over next year, that presumably is good for CES?
Yeah, that would certainly be a tailwind if more drilling activity were to occur, which wouldn't necessarily be our base case, but if that were to occur, they would catch that tailwind for sure.
And of course, as soon as we started talking about fluids, drilling fluids, I started thinking about this character, Chris Wright, who runs Liberty Energy, the oil field services company. And he's now nominated to be Trump's energy secretary. And he, back in 2019, drank fracking fluid, a mixture of water, bleach, soap, and other substances. So we can expect some showmanship, I think, here from the new Secretary of Energy, if he's confirmed.
Yeah, I think the U.S. under the new administration would like to see drill, baby, drill. I don't know if producer behavior will be impacted by that view, but there's certainly a better tailwind there than there has been in some time.
Yeah, another thing, he picked a fight with North Face, the maker of outerwear. They came out against oil industry links. So he put up billboards that said, "That North Face puffer looks great on you." And it was made from fossil fuels. So this guy doesn't back down from a fight. Leave us with your thoughts just on the energy services sector in general. So does 2025 look like a decent year, despite a fairly low oil price right now?
I think there's a little bit of a difference between Canada and the US. In Canada, with LNG Canada ramping up, with TMX now online, there's certainly a runway to see pretty healthy activity for a prolonged period of time. And the stocks, generally speaking, across the space, I think are still cheap. So the Canadian OFS outlook for 2025, I think, is fairly constructive. The US, I do think we're finding a floor in drilling activity. US oil production and gas production are roughly flat year over year on this rig count. And so as we head into 2025, if nothing changes on the oil side, at a minimum, we have LNG capacity in the US ramping up. And I think there will be a draw on gas demand, which could see a little bit of a pickup in activity. So generally constructive, I would say, and valuations are still fairly attractive across the space.